Well, the latest inflation data is out in Canada today, and it did tick up in the month of December. For more perspective on what it means for the inflation fight and what it could mean for the Bank of Canada's plans when it comes to interest rates, let's bring in Stephen Brown, Deputy Chief North America Economist at Capital Economics. Stephen, thanks so much for joining us this afternoon.
It's a pleasure.
So, it's interesting with this data, not only did the headline rate accelerate, but also the core rates, which tend to be what the Bank of Canada looks at more closely. How did you interpret the reacceleration that we saw across these different gauges of inflation and what it could mean for the Bank of Canada?
Yes, I mean, it was really a concern because most economists expected the headline rate to pick up just due to gasoline inflation and base effects from last year. But what we saw in the core numbers is definitely a real concern, because if we look past the annual figures and just focus on the month-on-month figure, they rose at an annualized rate of almost 5%, so obviously far in excess of the 2% inflation target. And what that is really telling us is that inflation has picked up in a broad manner around the turn of the year. Now, I think concentrating on those month-on-month figures can be, a bit misleading. We have seen this happen before. It happened in the summer, and prices quickly dropped back for goods. And a couple of things that did pick up quite strongly in December, like airfares rose very strongly on the month, vehicle prices rose very strongly. We actually expect those to drop back quite quickly. So they're probably giving us a bit of a false impression of just how strong inflation is. But certainly from the Bank of Canada's perspective, it's going to be thinking that it can't really begin cutting interest rates anytime soon, as some had hoped.
Yeah, and you were expecting that the Bank of Canada could begin cutting in March, but this has sort of changed your perspective, Stephen?
Yeah, certainly. So when we look at the economic data, things have really gone from bad to worse. We had the bank's own surveys yesterday, now very much at recessionary levels, point to the labour market weakening even further. We did assume that price pressures would fall alongside that, but the move in December has really caused us to revise our view. So I don't think there's any chance of the bank now cutting until April at the earliest. I think taking a step back, what's quite interesting here really for the Bank of Canada is, if you look at what's driving inflation in year-on-year terms, it's very much shelter inflation. So rent inflation and mortgage interest costs are keeping the headline rate elevated. And, when the bank cuts rates, mortgage interest cost inflation will always fall. But there's not really anything the bank can do about rent inflation. And if anything, at this point, it's making the situation worse. We also had housing starts data today, which showed that housing starts in Toronto fell to the lowest level in 10 years. And obviously, that is a direct effect of higher interest rates, and is not going to make the housing situation any better. So I think at some point, the bank might have to accept that it needs to provide a bit of support, well, not necessarily support, but make policy less tight and just accept that inflation may remain above 2% sort of for the next 6 to 9 months. But really, it's done all it can in terms of domestic inflation pressures, as we can see by the weakening economy.
Yeah, we're going to dig into rent prices a little bit more a little later in the show, Stephen. But this report from Urban Nation suggested that there could be some moderation in rent price increases next year if people are able to buy homes who haven't been able to in the past year or so, if they've been sitting on the sidelines with mortgage rates as high as they are and the uncertainty. If we start to see some of those cuts coming, then, perhaps they might move out of the rental market. So there could be a little less demand on that front. What do you think of the, possibility of that having an effect?
Yeah, I certainly think that's relevant. And the other thing is that a lot of people did get into the sort of investor market during the pandemic when interest rates were very low. Maybe they bought an investment property with a 1% variable rate mortgage. Suddenly their mortgage rate is 7%. It's quite natural that many of those are trying to pass on those higher mortgage costs to their tenants where they can do. So that's probably having a factor driving rents up as well. I think what's really striking when you look at the most recent monthly rental data, we're seeing very strong rent growth in provinces, which are not normally considered to be sort of immigration hotspots, whereas rent growth in Toronto and Vancouver has now slowed very sharply. So I think that's telling us this is more than just immigration. There are other factors going on, and landlords are probably passing on those higher interest rates. So at least as interest rates stabilize and the bank starts to consider rate cuts, we should see both rent inflation and mortgage interest cost inflation come down.
In terms of the broader data, I mean, you mentioned a couple of points where you expect that there could be some easing, that where prices were high in December, where prices could be coming down going forward. So it does sound a little bit like this isn't hugely concerning in terms of a step back in the Bank of Canada's fight against inflation, Stephen?
For now, that's my judgment. I think there is a concern here that perhaps in Canada, the last mile, as we've been saying, is proving the hardest. So certainly when we look south of the border at the PCE measure of inflation, on an annualized basis, kind of over the last 6 months, that's been at 2%. Whereas Canada seems to be struggling to get to that last step down. And it could be that strong immigration is playing a role. It may be that just we didn't see the prices react as quickly as during the pandemic, so firms are still passing on those costs. I think it's quite clear at this stage that the economy needs a less tight policy stance. I don't think the bank wants to risk an outright recession or falls in employment at this stage, particularly when we know that most of the inflation pressure is now coming from those housing components. But this does depend on how firm the bank wants to be. Governor Macklem probably doesn't want to be remembered as the central banker that let inflation get out of hold or didn't quite do enough to get it back to 2%. And I'm sure that's something we need to consider.
I do wonder, too, I mean, even if or when the Bank of Canada does start to cut rates, just how tricky it's going to be to do that if you have a bumpy month like this month. I mean, if it does prove to be just a bump in the road and it's not something more concerning, if that happens when rates are coming down, the kind of pressure that the central bank might feel.
Yeah, and I think that's where it gets to this decision making on when to start cutting, because the bank probably doesn't want to cut 1 month, signal that more cuts are likely, but then change its mind, because that becomes very hard for investors to read, for businesses to respond to. I think it does make sense that the bank wants to be sure that inflation is going to return to 2%, or at least feel that that is very much the base case before it starts cutting rates. And I don't think we're getting that message yet from the inflation data, but equally, given how weak the economy is beginning to look, given the fact we have seen that almost 1 percentage point rise in the unemployment rate now, all the economic data is telling us that inflation should be coming down by more than this. And Governor Macklem has made the point many times before that central banks need to be forward-looking. If they wait for inflation to be clearly going to 2%, they've probably waited a bit too long, particularly when we're sort of this close to a recession at the moment. So I think there is an argument for loosening policy a touch, but certainly we're not talking about a loose policy stance. So there's very unlikely that the bank would be considering taking rates, say, below 3% within the next couple of years, I don't think.
Yeah.